startups work. Yeah, and I'd like to give you an introduction because it's good to understand, because we work with startups. We need to understand, or you need also to understand what startups are all about and how we need also to reflect on their needs, yeah, and their goals, etc., etc. Yeah, and because we need to deal with that also when we collaborate. So, what is a startup? A startup, there are plenty different definitions. Yeah, and I think one of the better definitions of a startup is which is an organization, yeah, or an entity in a group of people that is searching for a repeatable and scalable business model. Yeah, so it's only scalable if you can repeat your business model, because if you only sell it once or just a couple of times, yeah, then you're probably a craftsman, for example. Yeah, and but if you want to scale it, you need to have find something that is really scalable and you're able to bring it to many people. So, and I wouldn't say that someone who is a craftsman, for example, or let's say a farmer and who's doing something entrepreneurially, yeah, is not a venture. Yeah, but it's not the typical style of startups we normally talk about, which is this kind of tech-enabled startup that is seeking for venture capital to build a product, to scale the product, and make it accessible to as many people as possible. Because if you have many people, then you also have the ability, especially in software-enabled startups, to monetize your reach. Yeah, the usage of a service, for example, even if you just bill, let's say, a couple of dollars per user. Yeah, or you have a different business model like Twitter or Facebook, where you monetize the advertisement you can do on your platform. So this is a startup. So something seeking for a repeatable and scalable business. And such a startup normally needs venture capital to grow. And venture capital is someone who is giving equity into a company, yeah, receiving a share in the share count of a company, yeah, by doing a capital increase. Yeah, so for example, you have 100 shares, an investor comes and says, okay, I want to invest into your company. I give you 100,000 USD, for example, and I do that on a valuation of 1 million of the company. So I receive 10% of the newly created shares. Yeah, so then you have a share owner in your company, and normally this kind of scalable startups have an investor. Yeah. And so, and if you have an investor in your company, the investor at some point in time wants to sell the shares again, because the venture capital fund has also investors. Yeah, and venture capital fund doesn't normally invest their own money, yeah, or just a fraction of their own money. They aggregate money of other investors into a fund, right? And with this fund, they invest into a startup. And by holding shares into of a startup, they want to grow the startups first, mainly in valuation. Yeah, so what is the company worth? And then they want to get other investors on board, yeah, with an increased valuation. Yeah, because then at least on paper, your investment is worth more money. Yeah, because increase in valuation, you have a share in the company, then your share is worth more money. But it only materializes, yeah, when you sell your shares, right? Because otherwise it's just a book value that you have in your fund, and you want to realize it because or the VC needs to realize these gains by selling the shares, because the investor needs to, or the VC, the venture capitalist, needs to sell back the shares, give back the money to their investors, yeah, called the limited partners. So that's why a VC always needs to sell the shares. And that's normally only happening if the company is brought to a public market. Yeah, so having an initial public offering, for example, on the New York Stock Exchange or any other stock exchanges, because then they can start selling their shares to the public market, or when the company is sold to another company. Yeah, then the investor also receives money or sometimes shares of the other company that they then can give back to their investors. And this is the nature of a startup, that they normally have an investor and the company needs to be sold or brought to the public market so that the shares become sellable, yeah, via a stock exchange, for example. And then that is meaning you have different stages in a startup, yeah. And normally, if you have an idea as a founder, yeah, the founder is looking for the first investor, and the first investor is not an institutionalized investor, yeah, but it's a private investor called business angel, yeah, someone who has money and saying, okay, I believe in the team and in the idea, and I give you, let's say, a couple 10,000, 50,000, or even 100,000 of USD as a first investor, yeah, and then you invest into a team and the idea. That is called the pre-seed investment, yeah. So, and then they start developing their idea, doing the first validation of the idea in the market, creating a first prototype to test the idea, etc. Yeah, and then if they continue with that, they need more capital. Then they ask for a seed investment, which could be an institutional investor, yeah, so someone with a fund, or it still can be a number of private investors, still business angels, yeah. And then you raise the next round, which is then the seed round called, and you still normally don't have a fully functional and working and sellable product at that point in time. And then you build the first prototype that you can bring to the market to validate your product problem solution fit. Yeah, you continue validating your problem solution fit. Yeah, and then you do that, and then you find this problem solution fit, but then you still have no scale in the market, right? You need more money to scale that. And many of the startups don't have a working business model at that moment in time. So you're burning money, and to be able to burn more money, yeah, you need another investor, right? And this round would be then the Series A, which are almost to 100% is granted by institutionalized investors, so venture capital funds that focusing on this early stage of investments. And with this classical Series A round, which can go into the millions, yeah, and depending on the market, yeah, how high this investment round normally is, you then start on validating your product market fit. So you have a product and you're validating it with the market, with a business model to make it not only work on people using it, but also making it work business-wise. Figuring out what is the cost of going to the market, yeah, so attracting new potential users and customers that are willing to pay for it, and validating not only who is willing to pay for it, but how much they are willing to pay for it, and what is the cost of acquiring these new customers. And then you have two very important metrics at the end of it. Yeah, so what is the cost of acquisition? And what is the revenue I can make with this acquired customer? And for sure, this cost of revenue or cost of acquisition, yeah, should be lower than the revenue potential every acquired customer has, because otherwise you continue burning money, right? And if you have figured that out, which is called then the product market fit, then you raise another round of capital, because then you need to scale it based on the KPIs, customer acquisition costs and the customer lifetime value. Then you know, okay, if I acquire a customer, I make this amount of money. And if I can scale it to a certain amount, I have a working business model. And then you scale it, and you need more capital and more capital by bringing more investors on board. And at some point in time, the company is becoming cash flow positive. And then you can make a decision whether, okay, let's IPO this company, which will normally take up to 10 years. So this is a long journey. And then you have a working company, and or you have to decide to sell your company, which is also not so good. And so on and so forth. And by doing that, by bringing more investors on board, because as a startup, you start with 100% ownership in your shares. So you have full control about everything in your company. But when you bring in a new investor, you give away shares in your company. So you own then only 80%, and 20% is owned by the investor, right? Because they buy parts of your company. And then you're bringing another and another. And because you are not able to invest money yourself, you are diluting your shares. And that's why in the end, probably you as a founder only owning around 10 to 20% of your company, because you have so many investment rounds that you dilute out of your company, and you're also losing control over your company. And there are some founders that say, I don't want to lose control over my company, right? And therefore, you need to make a decision early on whether you are going the route of going into venture capital. So selling parts of your companies to get more equity into your organization, to make all this validation, prototyping steps, growth, etc. Or you say, okay, I'm doing that all myself, which is then called bootstrapping, because then you make a decision, I need to earn the money to grow the company, right? So, and this is called bootstrapping, and probably many startups in Africa do that to a certain point in time, because there is not so much capital available, because you don't have the ecosystem of venture capital and startups like, for example, in the United States or also in Europe. And by bootstrapping, you continue having the ownership in your company, which makes you more free, on the one hand side, because you have the responsibility for all of the decisions. Nobody else is telling you how fast you need to grow, what market you need to enter, what business model you might need to change. It's all in your responsibility and control, but in the end, you also might lose everything, right? And but you're losing your own money, and this is a different type of agency. Because you have the full responsibility and accountability for what you do. But the problem is, or the problem might be, that you cannot grow that fast, right? Because if you don't have external capital infusion, then you only can grow slower. And that might be a problem if you are in a highly competitive market where you have other startups that have external capital infusion. So they have more cash on the bank to finance the growth, or product development. And if you have to finance everything out of your own bank account, so the money you earn, or the money you invest yourself into, so your own money, then you grow normally slower. And if it's a competitive market, then you might lose the game, because when you are, for example, building a software or a service platform, or a product platform or a marketplace, then normally the ones win that own the biggest market share, because then they have a lot of power to control the market. And this is why this is a difficult decision to make as an early startup, do I do the bootstrapping thing as long as possible to secure enough control and power about my own company? Or do I enter the venture capital game, yeah, and bring external investors on board and give away control and power about my company? So do you have any questions on that? And this is a complex thing, and I could continue for hours, yeah, on the mechanics of a venture capital fund and so on and so forth. And we will explain you in everything in detail if needed. If there is a certain occasion, if you have a question, oh, this company is behaving like this and that, I don't understand that. They talk about an investor and etc. etc. So we continue this then on concrete examples. But if you have any questions for now, let me know. Otherwise, I could elaborate a little bit deeper on what might that mean for the startups we are working with. Or Thomas, you have anything to add, or did I miss anything?
No, you didn't miss anything. I can imagine that this is a bit overwhelming if you hear this all for the first time. So, and I was thinking, how can we digest this? So this is really
let's go into a
understandable.
concrete example how it might look like when we do that with Motherland. Yeah. So let's talk about the first, let's say, a more early stage company. Yeah. So the company has an investor. Yeah, so it's venture capital financed or it's financed by a business angel, but they are in an early stage. So what does that mean? Yeah, so that means the company has capital to build a team, yeah, and build a product, but that doesn't necessarily mean that they have a working product because they are still figuring out. They have money, but not necessarily a working product, meaning it's fully developed, or they haven't figured out if it really creates the value, right? So even there's a product and the company, it might mean it's really working, right? I don't think we have such a case because we are working with startups out of a program from GIZ, the ZEISS program. So those startups are validated that they are able to create the value, yeah, which we are looking for, and they are validated because they have a good founding team, yeah, which is important. So I don't know if all of the companies have venture capital finance or not, yeah, but we are going to figure that out. So I think we can make a tick on the value creation piece, yeah. So, and then that's why normally this early stage startups that are venture financed, yeah, they are still on the journey of validating the value proposition, yeah. And when they are getting into later stages, yeah, let's say they have a Series A investment, and that's why it makes sense to ask them in which financing round you are, then you can go for sure that the investor have made their due diligence, so looked at every detail of the company before they invested into the company. And if you are talking to a company that has a Series A, Series B, the probability that this company is on a track to have a working product that creates the value that we want to see is getting higher, because otherwise they wouldn't be able to receive the funding. So, but that also doesn't mean that they're out of the trouble, yeah, because it might be this company has a working product, they have customers, yeah, but it might be the case that they're not cash flow positive, right? So they cannot finance their working capital or their salaries and their go-to-market and all their activities, yeah, because they don't have to. They're financed by venture capital, they have a burn rate, and they can do that. What could that mean for us? Yeah, so it might be that there is a company and we are working with them together and they are not cash flow positive. And that might be that that will be then the case that they're after a first or after the last venture capital round, yeah, they already start looking for the next round, yeah, because there is a say, after the round is always prior the next round. Yeah, so if you have closed the money, the financing round, and you have the money on your bank account from the venture capitalist, yeah, you start looking for the next round, because it takes really months and maybe even a year to get the funding. So that might mean that we are working with a startup, yeah, that is maybe because of the current circumstances in the economy, yeah, so that we have a downturn in the economy, that the venture capitalists are looking deeper into the companies and are not giving away the money so easily. And we are working with a company that needs to close a new round, yeah, to finance their operations and also what we do with them, and having problem with it, yeah. So that might result in a situation that we are working with a startup that don't have the funds to keep on the operations of their company, yeah. And we might recognize that they are not pushing or supporting our project, or they have to turn down service or whatsoever, reducing the amount of staff when they have to lay off people because they have to reduce their burn rate, and they're on the search for a new round. So that could then also cause some trouble for us, because if they're not supporting us anymore, for example, because they're looking for a new round in venture capital. So that normally is not the case if we have or working with a startup that is self-funded. So they're putting their earnings into the growth and into the development of their own company. Yeah? So because they take care of that, but they also might have to reduce costs because of market changes. But it will be not that fundamental that they need to shut down from one let's say 1 week to another, because if they're doing their business properly, they can calculate it a little better, yeah, than a venture capital financed company. Yeah, so they probably are more stable due to the fact that they anyhow have to finance their own growth and their own operations by the earnings they make. Yeah, so that is better. So I think that might be interesting to have a look at and understand when we work with a startup and look, okay, in which financing round they are. Yeah, are they currently looking for a venture capital round, or are they bootstrapped, or are they are cash flow positive, so that they can finance their own operations? That could make a difference. So, and how maybe we could help them. Yeah, because that's also could be interesting. So why we have to offer something to them? Yeah, and what we have learned so far, talking to startups in Africa, they are mainly operating in areas where they have the infrastructure, so internet connection, or other companies are already operating. Because if you're having, let's say, a logistics company, it doesn't make sense to operate in a company in an area where you have nothing to transport, right? Or the transport is managed in different ways. So, and I think what we can offer to those companies is, in the end, business development, yeah, to bring their solution to, for example, Seaya County, yeah, and helping them to go to this market, which they otherwise wouldn't do, because there is no infrastructure. It would be too costly to hire a team, for example, on the ground, because they know they need to have a team on the ground. And what we actually do for such a startup, yeah, is business development, yeah, by presenting their solution, yeah, for example, a logistics solution, or a market matching solution, or a learning solution, or a crowd finance solution, because we want to test this solution within our community, right? And we have staff, so we have you and we have your team, yeah, and that is working together with the community, figuring out if this solution can create the aspired value, yeah, for the community to solve the challenges. And so this is something actually I think is good, what we can offer to the startup. Yeah. So figuring out if their solution can be brought in terms of customer acquisition to a county or to a village, yeah, and a community like we want to do. Yeah. So, and that is actually a good thing for a startup. And we do another good thing, which we have figured out, is connecting it with other technology solutions from other startups. Because, for example, stick to this example of logistics. Yeah, logistics only work if you have something to transport that needs to have a market connection, for example, from a producer to an off-taker. Yeah, because then you need logistics, right? And if you don't have this logistics solution, the market matching solution, then you probably don't need a logistics solution. Yeah, and vice versa. So they are depending from each other's services. And what we do with our approach, we bring many of them together so that the probability that it works to go to this market is becoming bigger for them. Yeah, and that is not only an opportunity for them, but this also could become an opportunity for us and for you on the ground, because if we figure out how to bring that to a community, then we have a high probability not only bringing it to one community and one neighborhood, but we can bring it to many more people, right? And we understand how to do that. So that will bring us into a position where we can start talking to a startup and saying, okay, we are going to bring it not to 500 people, but maybe to 50,000 people. And we know how to do that. So are you willing us to pay for this service that we offer to you? Yeah, to go to the market. And then we can get a share of the revenue if we bring those startups to those communities, yeah, so that they pay us for every new account that is opened, yeah, for everyone who's using their solution, and we get paid for it. So that is the potential to finally finance you and your team independently from receiving more grants, which making it more sustainable, yeah, to finance a team and to finance growth and to really build this flywheel on the ground. Yeah, so that's why I think it really makes sense to connect the startups and the approach that we have. And another thing is happening, which is interesting for the startups. Yeah, because as we are having also good connections to potential investors, yeah, whether they're sitting in Europe or in Israel or in the United States that are looking for investment opportunities, also in Africa. And if we work together with those startups, yeah, what we do is in the end validating, are there real good startups? Do they offer a service that is really solving a problem of the people on the ground? We know that when we're working together with them for months. Are they really a team that is able to deliver and is great to collaborate with? So it's really kind of a validation of the startups. And if we identify startups that are able to deliver with their product, are a great team, good founders, then we are able to say, okay, we can introduce you, so the startups, to a venture capitalists, maybe in the United States, maybe in Europe, also in Africa, because we then have a qualified flow of potential deals, yeah, for these investors. That's interesting for the investors. So we create value for the investors, for the potential investors, and we also create by that value for the startups. So they should be keen to work within Motherland, yeah, because we then can funnel and connect them to the right type of investors, and the investors trust us because we have worked with the startups. We know what we are talking about, right? And so we can create value for both ends, the startups and the investor. Does that make sense for you, Kat?
I think it does. It's very it's amazing. And I wanted to ask you a question before you presented the last part. I wanted to ask, like, these startups, what's in for them? How do they benefit from, for example, if we start working with the Malanda thing? I think you've given me one of the answers, you know, by validating the startups, knowing how good they deliver, if it's a startup that can be worked with, good founders, we can connect them to venture capitalists. Is there any other way that they benefit from working with organizations like Motherland?
Yeah. So that's a very good question, and the startups will and should ask that. Yeah. So because they have to take care of the growth of their business, right? So I think there are a couple of things and something that we don't offer. Right now, we don't offer any grants, for example, for them. We don't want to play this game because that would be the wrong type of an incentive. Yeah. So what we can offer is that we take care of some of the payments, for example, for using the service. Yeah, so that the community does not have to pay for the service in the first, let's say, 6 months. Yeah, so that might be one way, but this is nothing extra. This is just for the usage of the service, and we take care of that. The startup is paid like they are normally paid from their customers, and we can compensate if we think that is required. But we need to be careful with that because we want to also make it feasible for the community to take care of such payments themselves. Because otherwise, yeah, if we say, okay, we pay for it the next 6 months and then we are gone, for example, then they might stop using the service, which we don't want to do, right? If they cannot afford it and it's not working within the community. So we have to be careful with that by promising anything. But in the end, the startup shouldn't care from whom the payment is coming. We have to decide how to support that if we see there is needs for some support. What we also cannot do, because we are not a venture capital fund maybe yet, yeah, so investments into the company directly, but that might be a business model of Motherland also in the future, yeah. But therefore, we need to validate if we can create this program, yeah. And so we cannot offer that. But what we can offer is, first, Thomas and myself, and also Diana, we can do some mentoring for the startups, and also Philip of GIZ, yeah. And we can also open up our network in connecting them with some people where we think we can create value for the startup. I think this is something we can do, like in an accelerator program, for example. Yeah, so we can figure out where we need to support the startups and where they need support. Yeah, but the most important value should be this business development aspect. So we say, okay, in the end, we help you with business development going to a region in Kenya where you're not active yet. Yeah. So we help you to develop this foothold in Siaya County. Yeah. So that is value we can offer because we have a dedicated and a very good team on the ground. Yeah. And we share the learnings that we have in this community with you. So that is interesting. Yeah, and in the end, maybe this last piece is we have a network of potential investors, and if you are doing a great job, we are willing to connect you and help to get in touch with investors. But this is not a guarantee. Yeah, this is something we can do if we have a very great collaboration. Yeah, and then we have an intrinsic motivation to connect you to someone within our network that might be interested to invest into your company. But this is not a guarantee. Yeah. So, but we also don't take for the services that we offer any payment, yeah, which some of the accelerator programs do. And we also don't take any equity. Yeah. So because we also don't have to offer. If we develop this program further in the future, this might actually look different. For example, if we found an investor ourselves that's saying, oh, you have access to that amount of great startups. We built a fully fledged program, and the program will have more mentoring and connection to investors, and this all in a structured way via the program. We can do that, but we cannot do that in the prototype because we don't have the funding to do that properly, because we don't have the time, and we should focus really on the implementation piece, yeah, of the solutions of the startups in your community. This is what it's all about. So
That's
and maybe lastly, probably most of the startups coming out of this SIZE program from GIZ, yeah, and they probably also can hope, if the program is going great, that GIZ might help support them, or we can connect them, for example, for loan financing of future projects to the Development Bank of Germany, yeah, which is the KfW. Yeah, and because if we can, so to say, testify great startup, then the probability that they're able to get a loan from the Development Bank is also going up. Yeah. Great. So I need to drop out now. Yeah, but I think that was kind of a glimpse into this kind of venture capital finance startup world. And you have us, if you have any questions, yeah, if you're talking to a startups and the startup is somehow telling you something about whatever, yeah, just ask us and we make sense out of it together. Yeah. Great.
Okay.
So I need to run because it's an appointment outside of my home. So not possible to do that virtually. So I really need to run and sit on my bike and go to the appointment. So it was a pleasure talking to you, Kat, and looking forward to continue. Bye-bye.
Thank you so much, Sebastian. Bye.
Yeah. Bye-bye.
Are there any other things you'd like to discuss, Kat?
Not really. I've
No?